What's up, you guys? My name is Oscar, and in this video we're going over a basic beginner's guide to the stock market. We'll be going over what a stock is, what the stock market is, the different styles of investing, and help you understand how to get started. Because this is one of the easiest ways to start investing, and you can do it as soon as you turn 18. So with that said, let's get into it. So what is the stock market, and what is a stock? The stock market is where you can buy and sell individual stocks and other investments, and a stock is all the collective shares of a company that is available on the stock market. So for instance, if you buy Coca-Cola stock, you are buying, or trading as it's commonly referred to as, you are buying a fraction of that stock, and each of those fractions are called shares. So by owning those shares, you become a very small owner in a much larger company. So what's the difference between a public company and a private company? A public company is a company that is listed on the stock market, and it is called a public company because it is something that the general public can invest in and own. While a private company is the exact opposite. A private company is one that is not available to be purchased by the general public, and it is held by only a handful of shareholders. An example of a public company is one like Coke, which I mentioned earlier. You could buy a share of Coca-Cola for $54.02 at the time of this recording. And an example of a private company would be Racetrack. You can't invest into them because they aren't available to the general public. So now, how do you buy stocks? The easiest way to buy stocks is by doing it right on your phone or your computer. You can do this by opening an account with a brokerage like Robinhood, Webull, Vanguard, and many more. I have personally used Robinhood and Webull, who will be giving you 3 free stocks whenever you deposit $100 or more onto the platform, valued all the way up to a combined $3,450. And I will leave the link for that in the description down below. Shameless plug aside, I highly recommend both Robinhood and Webull because neither one of them charge you a fee to make a trade, and neither one of them charge you a fee to maintain the account. And they are both very easy to set up an account with, and like I said, you can do it right on your phone in just a couple of minutes. So now you know how to buy stocks, but what about when? Not including holidays, the stock market's regular trading hours are from Monday through Friday, 9:30 a.m. to 4 o'clock p.m. Now some brokerages let you trade earlier or later in the day, but the regular trading hours are from 9:30 a.m. to 4 p.m. Now let's talk about individual stocks versus index funds and ETFs. Individual stocks have the biggest potential for upside and downside. On one hand, you could pick a stock that goes up 15% in price, which is really good. But that same stock could end up going down 15% or even worse. That is the beauty of ETFs and index funds, because with those, your money isn't just invested into one stock, but instead, they're diversified into dozens of other stocks so that if one of them goes down, you still have the rest of them who could pick up the slack and keep going. But the opposite can also be true. If the price of one of the stocks in the fund skyrockets, then the gains would be averaged down by the others. But that could be worth it if you want to take a safer approach to investing, but that can still give you a good rate of return. So how do you make money, you may ask? There are primarily 3 ways of making money in the stock market. The first one is probably what most of you think of when you think of stock market investing, with all the charts on screen, buying dozens of shares one moment and selling them all a few minutes later. This is known as day trading, and it is when someone buys into a stock with the expectation of selling it that same day. The infamous buy low, sell high strategy. I also include swing trading into this one type, because it is essentially the same thing as day trading, except instead of buying and selling on the same day, swing trading is when you buy a stock one day and sell it a few days or weeks down the road. The next type is the buy and hold strategy, which is exactly what it sounds like. This is when you buy an individual stock or fund with the intention of holding onto it for several years while ignoring the day-to-day volatility, because the longer you are in the market, the more likely you are to turn a profit. Now obviously, if the company is on the verge of bankruptcy, you want to get out of there. But if there's nothing wrong with the company and you believe that the company and the economy will improve, then just keep buying. Because with this strategy, you make your money by the price of the stock naturally going up over time. And the third way is by investing into dividend-paying stocks, which is what I prefer doing at the moment. A dividend is a company's way of rewarding their shareholders for investing in their company. Dividends can vary widely from company to company, and many companies don't even offer dividends because they aren't required to pay them. And even the ones who do pay them can decide to cut their dividend yield or get rid of it entirely. The dividend yield is the percentage that you would get paid for every dollar you invest in any company. So let's keep using Coke as our example. Let's say you have $100 invested into Coke, with their current dividend yield being 3.07%. Well, every year you would receive $3.07 for every $100 you have invested in the company. Which I know doesn't sound like very much, but as you keep buying more and keep reinvesting the dividends, it gets the chance to start compounding and grow into something much larger. And you not only make money from the dividends, but also from the appreciation of the stock itself. Now there's also a fourth option which is pretty popular, which is called options trading. But if you're watching this, then you shouldn't even touch that with a 10-foot pole. Ask me how I know. Now each strategy has their own way of making money, but they also have their own unique way of losing money. Day trading is by far the one you'd be most likely to lose money on, because 80% of day traders lose a median of 36% of their money after just 1 year, primarily because of overconfidence. See, day trading is a very risky style of investing, and a 2017 study found that when day traders made a profit, they tend to disproportionately attribute that success towards skill rather than luck. And whenever they lost money, they would tend to attribute that towards bad luck rather than a lack of skill, which would make them more likely to make riskier trades and lose even more money. And with the buy and hold strategy, so long as you invested into a company with a bright future, or even better, an index fund, you are highly unlikely to lose money after holding it for at least 20 years. And in the meantime, the only thing that could hold you back would be if you let the day-to-day volatility get in your head and make you sell prematurely. Now you still have to worry about this with dividend stocks, but there are also things that are referred to as dividend or yield traps. This is when a stock's dividend yield is way higher than what should reasonably be expected. Companies do this to trick people into investing in them, and once they have raised enough capital, they cut their dividend and leave you high and dry. So if the dividend yield looks too good to be true, it very well could be. So how much does it cost to get started? It is easier than ever to start investing in the stock market because many brokerages now allow for fractional shares for as low as $1. Now you are very unlikely to see any sizable returns with even a couple $100s, but you can start learning how to overcome the fear and anxiety that comes with the fluctuating stock prices, and understand that you don't have to watch how your stocks are doing every minute of every day. Because if you're in it for the long haul, the price that it's at today won't matter in 20 years. What will matter is whether or not you invest consistently and let compound interest grow your money for you. But anyways guys, that wraps it up for this week's video. If you like this video, make sure to leave a like and comment down below. Let me know if this video helped you understand stocks and stock market investing a little better. I'd love to hear what you guys have to say. And lastly, if you guys want 3 free stocks, make sure to sign up for Webull and deposit $100 using the link in the description down below. And with that said guys, thank you all for watching, and I will see you all next week with another video.